Assalamualaikum. My name is Ahmad Mulisimi Yaakob and I will be sharing you some 10 common English terms used for capital investment. So first of all, what is capital investment? Capital investment is the procurement of money by a company in order to further its business goals and objectives. The term can also refer to a company's acquisition of long-term assets such as real estate, manufacturing plants and machinery. So the first one is margin. In the investing world, buying on margin means borrowing from a broker to purchase stock. You pay only a certain percentage of the cost. The remainder of the money is borrowed from the broker, also known as margin trading. The term buying on margin comes up in discussion about leverage. If you can borrow money to invest, that's called leverage. Then you can potentially access returns you wouldn't otherwise get. Of course, you could also potentially lose the lot. This is a measure of how profitable a product is. In other words, it shows how much money from every sale of a product that the business keeps. The margin is expressed as a percentage. Number 2 is equity. Searching for an equity definition understandable in today's world, especially when the word equity can have so many different meanings when applied to a different situation. In short, however, equity means ownership, essentially referring to how much of something you actually own, taking away any outstanding charges due or any money that was borrowed to buy it. The following accounting equation represents equity. Assets minus liability equals equity. If you've ever made an investment, you will have likely come across the term equity. In this context, equity refers to stocks and shares, one of the main asset classes of an investment portfolio. Number 3 is allowance. Customers receive price discount on defective items that they nonetheless wish to purchase. The amount deducted from the purchase price to account for the defect is called an allowance. The clothing store customer who requests a price reduction for loose threads on a pair of pants she's buying and receives a percentage off is engaged in an allowance transaction. An allowance is similar to a return in the fact that the seller is giving the buyer a credit on the account because something is wrong with the order. In the case of an allowance, the physical inventory is not returned to the seller. The buyer gets to keep the merchandise but receives a discount on the merchandise. Sometimes this happens because the inventory is incorrect but the buyer thinks it can still be sold. Maybe it was the wrong color, or maybe there is a slight damage to the product, but it can still be sold at a discount. When dealing with allowance, it is important to note if the value of the inventory is changing on each side of the transaction and record that change correctly depending on the inventory method being used. And number 4 is convertible loan. Convertible loan is when an investor loans funds to your business with a set interest rate. You make regular payment back to the investor at the agreed rate until the loan reaches maturity. What makes a loan convertible is what happens once the loan matures. With a convertible loan, your investors can choose to convert the loan into shares or equity upon evaluation of your company. Some loan agreements will convert into equity automatically, and others will offer the choice to investors upon maturity of either receiving a lump sum or taking shares. You will decide this and set this out in the terms of your investment after once you've determined which is best for your business. A loan that is extended to a business that could be converted into equity. Number 5 is line of credit. A line of credit is a type of loan that lets you borrow money up to a preset limit. You don't have to use the funds for a specific purpose. You can use as little or as much of the funds as you like. Up to a specified maximum, you can pay back the money you owe at any time. You only have to pay interest on the money you borrow. To use some line of credit, you may have to pay fees. For example, you may have to pay a registration or an administration fee. Ask your financial institution about any fees associated with a line of credit. Usually, the interest rate on a line of credit is variable. This means it may go up and may go down over time. You pay interest on the money you borrow from the day you withdraw money until you pay the balance back in full. Your credit score may affect the interest you'll pay on a line of credit. It tells lenders how risky it is to lend you money. Usually, the higher your credit score, the lower your interest rate on your line of credit will be. This is basically financing that you need to pay back at a certain interest level. A line of credit can be reused as long as the original sum and interest are paid back. Number 6 is proprietary. A proprietary process is a manufacturing process that others are forbidden to use, and a proprietary trademark is a name that only the owner can use. Legal rights of this kind are ensured by copyrights and patents. After a certain period of time, invention and process lose their legal protection, cease to be proprietary, and enter the public domain, meaning that everyone can use them freely. Baseball fans often take a proprietary attitude toward their favorite team. That is, they behave more or less as if they own it, even though the only thing they may own is the right to yell from a bleacher seat till the end of the game. A term referring to ownership in an idea and the fact that no one else can copy. If you have a patent, trademark, or some other intellectual property, your idea is proprietary because no one else can copy you. Number 7 is patent. A form of intellectual property on an invention. This means that the owner of the patent can exclude anyone else from making, using, selling, and even importing that invention. No one can copy you. No one can copy the patent product. Patents provide an incentive for companies or individuals to continue developing innovative products or services without the fear of infringement. For example, large pharmaceutical companies can spend billions of dollars on research and development. Without patent, their drugs and medicine could be duplicated and sold by companies that didn't research or invest the needed capital for R&D. In other words, patents protect the intellectual property of companies to help their profitability. However, patents also serve as bragging rights for companies demonstrating their innovativeness. Number 8 is contingency. A contingency is a potential negative event that may occur in the future, such as an economic recession, natural disaster, fraudulent activity, or a terrorist attack. Contingency can be prepared for, but often the nature and scope of such a negative event are unknowable in advance. Companies and investors plan for various contingencies through analysis and implementing protective measures. Investors protect themselves from contingency that could lead to financial losses related to investing. Investors might employ various hedging strategies such as stop-loss orders, which exit a position at a specific price level. Hedging can also involve using option strategies, which is akin to buy insurance, whereby the strategies earn money as an investment position loses money from a negative event. The money earned from the option strategy completely or partially offsets the losses from the investment. However, this strategy comes at a cost, usually in the form of a premium, which is an upfront cash payment. Investors also employ asset diversification, which is the process of investing in various different types of investment. Asset diversification helps to minimize risk if one asset class, such as stock, declines in value. An agreement to do something as long as another thing happens. And number 9 is valuation. A valuation is an estimate of how much a business, property, entity, or any asset is worth. If you have a business and seek funding from investors, they will need to know how much your enterprise is worth. This is achieved through evaluation and estimate of your company's overall worth. Many different techniques may be used to determine something's value. An expert who is making a valuation of a company will look at its management, its capital structure, the market value of its asset, and its outlook. In the world of business and finance, items that are typically valued are financially assets such as stocks, options, commercial enterprise, patent, or trademarks. Valuation may also be carried out on liabilities, such as the bonds issued by a company. The equity stake helps to find the valuation of the company. The valuation of the company tells you how much the company as a whole is worth. You can find this value by dividing the investment by the equity stake. And last but not least, net sales. A company's total gross sale is an important figure, but it doesn't tell the whole story. The gross sales are the value of all the products a company sold over a particular period. But plenty of factors might result in a company bringing in less money than what the sold products were worth. Things like sales returns, allowances, and discount coupons can reduce the overall amount of money the seller makes at the end of the day. Net sales doesn't only apply in the retail space. Net sales would also apply to a manufacturer, for example, who tracks its sales to wholesalers or other customers. Companies often subtract these factors from their gross sales to determine their net sales, which gives a more accurate look at their sales performance. This is the gross sales minus return, allowance, and discount. Net sales are usually compared to gross sales to determine the quality of the product, which means the large difference between gross and net sales could mean a quality issue, since many people may be returning the product. And in conclusion, all business and investment projects need capital to operate. However, financial capital, the money tied up in the business, it's not free. A project's cost of capital is the minimum expected rate of return the project needs to offer investors to attract money. Simply put, the cost of capital is the expected rate of return the market requires to commit capital to an investment. Thus, the cost of financial capital to a firm is the return the firm's investor, debt and equity holders receive from lending their savings to be used by the firm's portfolio of investment projects. That's all for me. Thank you very much.